It is 20 minutes after 2. A very good afternoon to you and welcome to the Monday edition of Market View right here on Eswatini TV. My name is Nonselestole and welcome to the program. On the program today, actually, the Eswatini Electricity Company has announced a net loss of 80 million emalangeni for 2025. The loss is driven by severe drought conditions, limited access to affordable power imports and soaring electricity costs. Even with revenue rising to at least 3.1 billion emalangeni, the company's operating costs outpaced income, raising serious concerns about liquidity, tariff pressures and long-term sustainability. We'll speak to economist Anele Sibia to unpack what these numbers mean for energy security, but also for consumers. But first, our business news this afternoon. In our business stories, we begin with this. The Eswatini Electricity Company has reported that for the financial year that ended 31st of March 2025, this year actually, it recorded a net loss of 80 million emalangeni in 2024. There was 100 million emalangeni in profit. The report states that Eswatini Electricity Company has an operating loss of 247 million emalangeni. The company's performance was severely impacted by a regional drought that disrupted local electricity generation and limited the availability of affordable imports from the Southern African power pool. Revenue from electricity sales rose to 3 billion emalangeni, up from 2.6 billion emalangeni in 2024, representing an 11.7% increase. EEC says this growth was primarily driven by a 9.08% tariff increase approved by the regulator ISERA for the 2023-2024 and 2024-2025 financial year under a multi-year award, along with a 1% increase in sales volumes. Current assets of the 31st of March 2025 stood at 1.113 billion emalangeni, which includes cash amounting to 28 million emalangeni, short-term investments of 136 million emalangeni, trade receivables of 473 million emalangeni, and inventories at 127 million emalangeni. The trade receivables saw a 23% increase as a result of delayed grant receivables. Government and some state-owned enterprise accounts have long overdue debts, a situation that adversely impacts the company's cash flow. Total liabilities show a 24% increase from 2.1 billion emalangeni to 2.6 billion emalangeni. The increase is mainly due to a new 200 million emalangeni loan facility from Stanlib, additional drawdown from the World Bank loan, and rural electrification grants received during the year, which have been recognized under deferred income. The company also saw an increase in trade payables due to delays in meeting month-end obligations, a situation stemming from cash flow management issues. The company's net assets shareholders' equity value stood at 3.9 billion emalangeni in 2024. They were at 4.0 billion emalangeni, an overall decrease of 3% from the previous year. The decrease in shareholders' equity, according to EEC, is a result of the loss recognized during the year. During the year under review, no dividend payment was made as dividends were not declared for the 2024 financial year due to the deepening liquidity challenges. The company closed the year with a positive cash balance of 28 million emalangeni, and in 2024, it was 131 million emalangeni. The company says the 104 million emalangeni net decrease in cash is mainly due to increased operational costs, while inflows remained stagnant. Additionally, the company continued to invest in several capital projects which required significant outflows. The report states that the company remains heavily reliant on a 135 million emalangeni overdraft facility to fund its operational working capital requirements. This facility is typically cleared at month end when payments from key customers are received. In other stories, 16 local artisans have been added to the Home of Faber Guide, which is an online platform dedicated to craftsmanship that allows artisans to showcase their works to a wider international audience. Head of Strategic Relations at Michelangelo Foundation, Andrea Tomasi, has more details.
The Home of Faber Guide is an online platform, is an online directory of artisans. So it's a project of the Michelangelo Foundation that is a Swiss foundation. And in 2020, we created this online platform to give visibility to artisans. Eswatini is one of the 53 countries in the world present in this platform. So today we are launching 16 artisans from Eswatini, and thanks to this platform, the Eswatini artisans will be visible worldwide in our platform, so they are recognized as master artisans from our institution, and of course thanks to the possibility of being visible on the guide, they could let's say have more requests, and also the platform that we created is a tool for visitors. So if someone is coming to Eswatini and wants to know the artisans from Eswatini, thanks to our platform, they can have access to this group of 16 artisans.
Different artisans have expressed gratitude over being part of this platform.
Being part of the Home of Faber Guide is a very good and beneficial thing for my business and my brand as an artisan, because now it gets to expose my work to a greater audience around the world, and also allows me as an artist, or gives me rather like the ability to create, or creative freedom in a sense, to continue to highlight our culture and promote our culture throughout the world.
This initiative is supported by the International Trade Center through the European Union. Reporting, Nelson Langamandla, Vominkosi Nzinisa, Ezulwini.
And you're up to date with some of the latest in business. Stick around. We're in conversation with in-house economist Sanele Sibia after this.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.sz.
Welcome back now for our discussion segment. The Eswatini Electricity Company recorded a net loss of 80 million emalangeni and an operating loss of 247 million emalangeni for the year ending the 31st of March 2025. What does this mean for consumers and, of course, the future of sustainability for the company? I'm joined by economist Sanele Sibia. Very good afternoon to you, Mr. Sibia. Thank you so much for your time. Perhaps you could start us off with your initial reaction to EEC reporting a net loss of 80 million emalangeni after a profit last year, actually.
Thank you, Natsile. I think for me it was expected. Remember, they had asked for a double-digit tariff increment, and Parliament at that time came back with 9.8 or 8 point something. The numbers are losing. I'm losing the numbers right now. But the argument that was made last year was purely to say we need to be in a position to cover operating operating costs. Yet, in the eyes of the public, when we look at an entity that's making money, then we ask ourselves, why then do they want to charge this much tariff? But it goes towards the operations. You need to make sure that you can replace the capital that gets worn out. You need to ensure that you can pay suppliers and be in a position to basically sustain the utilities company. So it's not surprising for me to see that they actually did report a loss after a profit type of region. And if you look at the numbers from last year, it was already indicating that they need to recover, I think, something in the 110 million region in terms of cost recoveries that they needed to be able to implement so that they'd be able to stay on the green, right? So in a nutshell, it's not that much surprising. It was quite expected.
After applying for a tariff increase that was, well, rather not well received, especially in the court of public opinion, and now they come out to say that, well, the primary reasons for this loss is actually one of the contributors was the regional drought. From an economic perspective, is that really a justifiable excuse to say that we are facing this financial decline because of a natural occurrence?
Yeah, because when you look at the way we generate electricity, it is largely dependent on the elements. So if you're not getting enough rain, that means you're not churning out enough power through the hydro power stations to actually power quite a number of households and sell more output. I mean, if you remember, between I think June to August, we had rolling load shedding in the country. That's largely attributable to the fact that dam levels were very low, and our ability to import from South Africa was somehow diminished at that point in time. So that meant the power utilities, they are not in a position to produce as much electricity as you would have wanted. So we do note and we do understand it's quite plausible. But what we need to do in light of this is to ramp up the going green pathway, more especially harvesting the sun. During drought years, the sun continues to shine. So if you can be able to harvest the sun and convert that into power and electricity, then you'd be able to sustain that momentum and be able to sustain the power that is required by households.
What are some of the broader implications then of relying on high-cost imports from other parts of the country, just, so that we have Eswatini, well, sufficient energy security?
So one of the things that we were worried about beginning of the year and with the new GNU and, the way the political architecture had changed within South Africa was what if we got a party into power that's going to focus mostly on making sure that South Africa stays resilient and sustainable and they're not getting that load shedding. But this time it came this side. So that means you could see the politics at play there to say, if you guys can just lower what we are exporting to you so that we can keep the lights on in South Africa. So another thing that we are looking into as a region is, that countries like Zambia and Botswana and Mozambique are now energy sufficient. They can be able to export their excess power. So what we need to do is to ramp up that regional power sharing agreement so that we buy straight more from that SADC power pool to offset these imports from South Africa. But you then find that even when you look at Zambia, it's largely hydropower as well. So when there's a drought in the region, so that power capacity gets diminished. But we do know that Botswana is on coal, and I think Mozambique as well, that they're generating through coal. In terms of sustainability for Eswatini, what we need to understand is the fact that for a country, electricity is one of the major backbones to the economy. So for us to relatively import quite a huge chunk of that from our neighboring countries really leaves us vulnerable and exposed, because we always have to play with the whims of what the regional politics of the time are saying. But when you also look at the cost of setting up and investing to build a power plant, can't. So I think that's where we are right now as a country, doing that cost-benefit analysis, whether it serves us or not to go out and get a loan to build yet another power station, and whether we can go through the fossil fuel pathway or we remain green. And yet, you know that with green energy, even though the costs have been going down relatively over time, but they still remain relatively expensive to set up and to maintain.
Right. Even with a 9.08% tariff increase, the company still recorded a loss. I think that's disappointing, or at least some would say we should not even be having this conversation. What does it say really about the balance between tariffs and operational costs?
What that says is EEC had done the numbers. They knew that they needed the 14%. So I find it quite an honest report from EEC to say we needed that 14%. And you know, the case of public utility companies is they tend to operate on what we call an extensive margin. They tend to operate where no business would operate, right? Where the cost structure really doesn't make sense. You kind of find yourself supplying a commodity below cost because we assume it's supposed to be subsidized. We are doing a public good. So what EEC was trying to get to was at least break even. Say, give me this 14%, so I can at least be in a position to repair the machinery and still be in a position to import, so that I can sell to you, right? And then when we came and it was quite plausible because the cost of living is already very high, right? So when you then want now to make electricity a bit more expensive, it does become a bit a bit worrisome. But what is happening at EEC is not just an isolated case. If you look at Eskom just across the border, you realize that the problem is not the power generation, but it's the maintenance and making sure that we can keep all the power plants running to provide the capacity. Ideally, South Africa is at capacity to supply the entire of the SADC region. But because of maintenance costs and all of those, so it's one of those conversations that we need to have as a country and as a region, and learn from where things are still relatively well done, and how then we can maintain the cost and then still be in a position to supply.
Right. As we wrap it up, I'd like to know if you think this performance, presents any risk, or, it poses any risk for future tariff adjustments or consumer electricity costs?
That's a given. Because right now what it means is if EEC goes back to the regulator and eventually to Parliament, and then they say, look, we got a 9% last year and we are now in this position, we are not even in a position to pay our dividend to the shareholder, who is government in this case. So that means we are in a situation that's a bit tricky. And like I said, an extensive margin means your costs actually exceed the price at which you sell, exceed your revenue. So then that becomes a bit tricky for companies to operate at that point. So what would then have to happen is either they get an injection from government or they get the tariff for this loss recovery, to just recover the loss and recover the cost. And that's going to be a bit on the high side. I mean, we should have just taken the 14 last year.
We should have probably. Thank you so much, Sibiya, for that. I will be seeing you in a minute. That was in-house economist Sanele Sibiya chiming in on the recent report by the Eswatini Electricity Company of a net loss of 80 million emalangeni for the year 2025, with revenue, however, rising to at least 3.1 billion emalangeni. Stay tuned. Our market analysis segment coming up after this. Welcome back. Sanele Sibiya joins us now for our market analysis. Sibiya, thank you so much again. Glad to have you in studio. So it is the first trading day for the month of December, first trading day for the week. How are things looking?
Thank you, Notsile. So what we're looking at markets are still remaining mixed. In the US, we're seeing a bit of a rebound. We know that we might have a new Fed chair come, December after this, the last meeting that we're going to see coming through from Fed chair Jay Powell right now. So we're seeing a bit of a rebound. When you look at the numbers, though, you can see that we are remaining very strong on those blue chips, and the Nasdaq, which is tech heavy, remains relatively, it just remains relatively below the all-time highs we saw last week, and it's still trying to recover back to the 24,000 mark because of those issues around the AI valuations. But we're seeing the S&P 500 back on the 6,800 mark, really canoring for that 7,000, and then the Dow Jones Industrial Average again up on to that 47,000 mark. Now that's purely because the blue chip stocks are expected to continue doing well, even being driven by this shopping season. And then when you move on across the board into Europe, there are a bit of divergences that we're seeing there. Back in London, we're seeing that, we're back on that 9,700 mark, but there are issues overall within the European economy, because we know that we are hoping to have somewhat of a truce between Russia and Ukraine, and it's more an issue of what it looks like. But what you would see is markets seem to be forecasting a bit of a surge in defense stocks and defense spending. But overall, when you're looking at sentiments, the investor sentiments and your manufacturing data, investor sentiments and basic consumer sentiments, they are pulling the overall Eurozone down, with Germany there, when you look at the DAX, losing some 272 points. It's really suffering a lot because Germany is dealing with an issue of manufacturing output declines. While in France, there we're seeing that the festive season seems to be doing well for France, and we do know we expect those the likes of your Hermes, your Louis Vuitton, and all these other luxury brands to benefit off of that. And then when you go across the pond to Asia, again, we're seeing a bit of losses in Japan when you are looking into Asia. It's largely driven by the fact that there is an interest rate expectation. We expect the Bank of Japan to actually hike interest rates this December, but markets are being supported a bit by the expectation of an interest rate cut within the U.S. economy. The Nikkei there and the Shanghai Composite Index, just restarting, and the Shanghai back on the 30,914 mark, largely because there's some stimulus coming into the markets through from the mainland China, and the Hong Kong markets, they are just beginning to price in that cut in the interest rate in the US, and it's going to support consumer spending. In South Africa, we're seeing the Johannesburg Stock Exchange on the 811,000 mark. That's because we're seeing gold continuing to glitter. We're seeing, the stability of the GNU. We expected President Ramaphosa to resign after the G20, though there was the rumor, what the rumor mill was churning out. But he's still there, and, there is a bit of stability coming through, so markets are reading into that as well. And then when you're coming into Eswatini, we have not seen any changes. And in terms of commodities, gold continues to glitter, largely because gold has become the go-to commodity. That's when, when inflation is going wrong, you buy gold. When crypto is losing value, you buy gold. With anything, the uncertainty, just buy gold. So right now there's a lot of uncertainties and people are just buying gold. And then when you're looking at the price of Brent crude, we've heard from the OPEC Plus group, releasing data showing that they're not going to increase output going forward. So now that seems to rally the oversupply fears that were already in markets given in the past few months. And then in terms of the currencies, given the overall expectation of an interest rate cut in the US, the Langani has strengthened against the dollar, because we're seeing that shift towards gold from dollar-based commodities to gold. But we are remaining relatively weak against the euro and also against the Japanese yen. That's largely because right now there are concerns about what a Trump appointee into the Fed will mean for the independence of the central bank, of the Federal Central Bank in the U.S. And now that is actually not supporting the dollar very well.
Right.
Thank you, Nathan.
Svia, thank you very much for your insights. That was in-house economist analyst Svia chiming in on what's making today's trade. Otherwise, this has been Market View. Thank you so much for staying with us. Until next time, take care.